that this is a game in which staying in the business the longest when you have edge, staying in the business the longest is the goal. And to do that, you just can't blow up. And I would say that most investors right now do not have the patience to let their returns compound. And they expect, and they've been rewarded by expecting that over years and even over months, that taking a whole bunch of risk and generating a whole bunch of return, which could just be lucky, can change your life. And if you approach investing like that, you're going to lose money. You're going to die, or you're going to get lucky and you're going to succeed. Because even a great process that has an astounding win ratio of, odds of success of 60%, if you bet all your money on and you have a 40% outcome, which is very common, 40% is like really common outcome, and you lose all your money, you're dead.
Welcome to the Rose Show podcast. Welcome. I am here today. I have the honor of being here today with Andy Constan. He has over 35 years of investing and trading global markets. No wonder you're one of the graybeards. Bioengineering from PENN, University of Pennsylvania. 17 years at Salomon Brothers, head of global equity derivatives. Macro investing at Bridgewater Associates, Ray Dalio. Started 2 relative value hedge funds, specializing in multi-asset volatility arbitrage and capital structure arb. And we're going to be talking about those. CEO and CIO of Damped Spring, a full service macroeconomic and commodity research firm. Got my good friend over there, Tracy. We have a great team there, DS Alpha. We're going to be talking about that as well. And you're one of the 2 graybeards. You have a great show on YouTube and you have a great website. I urge everyone to check it out. And you show people how you think about markets. And that's so important. And you also tell us how you make your decisions about adding or reducing risk in portfolios. Risk management is always number 1. So most importantly, we're going to talk about the why and when today. And you're also a chef and a baker. I mean, the bread that you bake, unbelievable. How you doing over there, Andy?
Couldn't be better. Lovely, lovely day out here.
It's a gorgeous day where we are. I call you my neighbor. You're a little further out there on the island, but you're like a neighbor here, and we have had gorgeous weather. So it means a lot that you're here today. We're very grateful for your generosity and sharing all your extensive knowledge and experience. So I want to get started with your background because it's pretty extensive. You started in bioengineering, then you went on to Salomon Bridgewater. Please walk us through that, how one led to another and how it led you to Damp Spring and to Graybeards.
Sure. Thank you for having me. It's really a pleasure. I've admired your work from afar for a long time, and it's an honor to be here.
Thank you.
When I was growing up, I was always into math and science, and so ended up being an engineer in college. And it was an interesting period of time. I graduated in 1986, many, many moons ago. And at that time, the spreadsheet had really just been invented. VisiCalc, and then, which I never used, and then Lotus 1-2-3, which predates Excel, had just really come into play. And traditional investment banking had really was not about creating spreadsheets. They didn't exist. It was about a couple of scenarios that the senior investment banker would talk about with his client for a merger, for an acquisition, for an issuance, for an IPO, with some, reasonable valuation metrics, but nothing fancy. And it was a relationship business. But all of a sudden, the spreadsheet came around, and that created a huge demand for junior people to run those things and to run all manner of what ifs. And so as an engineer, I always knew about Wall Street, but really as an engineer, I was happened to expect to go into engineering. My fraternity brothers were all heading to Wall Street, and they said, come and take an interview. And I got one job, and that was at Salomon Brothers. And Salomon Brothers was at the time as a rival to Morgan Stanley and Goldman Sachs. best known for trading fixed income, but also a full-size investment bank at that sort of competitive level, big 3 or 4. And so joining them, I joined in the corporate finance department. And then within a year, the stock market crashed, 1987. And I had made a decent reputation as an analyst, and they decided to second me to the Federal Reserve, to the Brady Commission, for a 3-month assignment to find out what happened. And when I arrived there, all the other firms, Goldman, Morgan Stanley, Lehman, JP Morgan, Merrill, had all sent senior people, and I was the junior person. But once again, that was a great advantage because I was the only one who could run the spreadsheet. So we had all these great senior people around me while we tried to figure out, using all the data you could imagine, what happened in the 1987 crash. And that's when I really fell in love with markets, and I've been doing that ever since. So my path at Salomon was joining the trading floor after my investment banking analyst career was over. I traded convertible bonds and ended up running that department after over my first 7 years, became a managing director there, and then took over the equity derivatives trading area. Then mergers happened with Smith Barney and Citigroup, and I assumed a global position overseeing derivatives trading and structured product creation, and then took over the whole business after the tech bubble. So I was in that seat during the long-term capital unwind and during the tech bubble. After 2003, I decided to join a bunch of other Salomon partners to start a hedge fund. We did relative value. I was the equity guy. These guys were mostly fixed income, and it went pretty well until our partnership sort of disintegrated. And I restarted with a handful of those partners and started another firm. But that happened in 2007. And so my timing there in terms of fundraising was bad. So that really never got off the ground. And we closed in late before the financial crisis started. After the financial crisis, I was looking for something to do. I wasn't ready to retire. And I realized the only thing I had been focusing on was very siloed investment strategies, relative value strategies. And what I needed to get a sense of was, why did all these strategies, convertible bond arb, vol trading, dispersion, capital structure, why did they all explode at the same time? Why were they not diversified? Every time a crisis has happened in the financial markets in my career, every strategy behaves the same. And so to me, the difference between investing is, if every strategy is going to stay the same, behave the same in a drawdown, there really isn't any diversification. It's all just beta. And so I wanted to understand why that happened. And thankfully, Bridgewater decided to hire me, and I joined them and worked for over 3 years with them and really learned macro from what I think are the best macro thinkers in the world. And because of their systematic nature, I was able to fit in well because of a strong bias to systematic trading. The culture there is complex, and it was particularly complex when I was there. And by the end, I was burnt out and decided to take the garden leave and wait for a couple of years before I restarted. And thankfully, I got to work at Brevin Howard, where Alan Howard has a massive discretionary hedge fund, and joined that team, worked as their strategist for a little over 4 years, and saw how a discretionary macro firm approaches investing. And that triggered the launch of Damp Spring. And Damp Spring was because Alan decided to take all of his research teams and fund them and take them out of house, allow them to have other customers, and pay them with soft dollars. So it was a cost reduction thing, but it helped me launch, and I'm forever grateful to Alan to help me launch to Damp Spring, which has become a macro research provider and strategy provider for hedge funds that in total have about $250 billion in assets under management. And, I provide half a dozen or so, maybe it's 15 macro hedge funds with my daily and weekly and monthly writings. And that has also at the same time, and I'm talking a lot, you could feel free to interrupt, but at the same time, we had COVID and we were all at home. And I had been on Twitter for, I don't know, 5 or 6 years as a consumer of news, but not a contributor of content. And I started writing with 100 followers in a little over 3 years ago. And I started engaging with the brilliant people that are on Twitter and challenging what they were thinking, but also, respectfully and trying to get a learnings from how they were thinking while contributing my own content. And my voice caught on. And so a year later, I launched Damp Spring for my Twitter clients. People asked me to create. I didn't even know about, the commercialization of Twitter commentary at the time, but they asked me to start something for that they could have much closer day-to-day access like my hedge fund clients. And so I launched that, and that's gone very well. I have, incredibly loyal clients that have been with me for the whole time. I'm reaching more and more people and paying back what I know and helping educate people across whatever level of sophistication they enter my sphere with. I catch them at their personal learning curve and hope to help to more rapidly allow them to progress on their learning curve by, a lot of hand-to-hand conversation. And at the same time, that's not scalable. So, I want to keep it small so that I can give my clients the best possible education I can provide. And lastly, along the way, I met a person who overlapped with me at Salomon, who I didn't know, Nick Giovannik, who was in London fixed income. And he and I said, what would be good for we need to have something scalable. What's missing in the marketplace? And what we think is missing in the marketplace is people with $3 million to $20 million are not huge ultra net worth clients. They most likely have no financial sophistication. They mostly made their money by their businesses and their income. And so they hand their money to financial advisors who charge them 85 basis points or 100 basis points, $300,000 a year. $30,000 a year for the minimum, 200 for the maximum sort of size we're looking at, to give them advice that by and large is informed by the prior 40 years of investing, in which 60-40 and bonds and stocks, even distributions, was the way to go. And we think we can do better than that. And what we do is we offer them a portfolio of long-only investing that is balanced, is fairly risk-averse, and with that guidance, hopefully they can have better conversations with their financial advisors. At least when, most of these people don't have at most 4 conversations with their financial advisors each year. And the way that goes, they don't retain anything. So we offer them one very short video once a week that gives them everything they could possibly need to have better conversations with their financial advisor for a very limited personal investment in their time, which is their most valuable commodity. And so that's where I am.
I love it. You know, you're very organized. That was a great walkthrough. You truly have an engineer's mind. You're very systematic with your thinking, and that was a great overview of everything. You know, you're right. You know, that 3 million to 20 million is like an underserved market right there. It's not enough to be in the super high net worth, and then you're not on the other end. So you're right. It's always the middle that gets lost in the sauce. So that's a great target market that you have, and you're truly democratizing global macro and themes, and your bond market knowledge and your TGA, which we're going to get into, is extensive, amazing stuff there. You know, timing is everything. And I know you've spoken about this. Market timing is very difficult, hence the long only. And that's what you do with your two gray beards. I love your website. You have ETFs that you work with. We're going to get into that as well. But I want to start with your diversification issue. You were talking about how, you were concerned about how all assets behaved in the drawdown, and you were looking for some type of diversification. And then you headed over to Bridgewater they're the best in global macro, in my opinion. What did you learn about that diversification?
Right. So there's two things that I would think about. There's making sure you know what alpha is and what beta is, and knowing how to earn money in each thing. And then the second thing is, in the beta portfolio, how do you make sure you have a diversification for all future environments? And both of those things were, something that Bridgewater really pioneered and really fostered in all of its thinking. And the first thing is alpha. Alpha is very, very hard. And what it means is that in order for you to make money, you have to take it from another participant in the marketplace. That every gain you make is someone else's loss, meaning it's a zero-sum game. Now, there's some money that operate in markets for non-financial reasons, meaning non-profit related reasons. Central banks are a good example of that. And so it may not be entirely zero sum. If the central bank is acting in a way that is not in their best interest from a profit standpoint, you can make money from them. But by and large, what it means is you're competing for crumbs in the global marketplace. And that may manifest itself in stock picking, where you think you can beat the index by picking stocks, or macro directional, where you think you can outsmart the bond market or the equity market or many markets, currency markets, all of them. And it's just very, very hard, and for a very simple reason. It's competitive. People are really smart out there. And so, just as Jack Bogle has said, passive investing doesn't play any of those games because it never pays a transaction cost. It never crosses the bid offer spread. It just sits there owning what it owns and doesn't create any costs. And when you talk about fees and transaction costs that people who try to beat the market, whether that's an active manager who charges more than Jack Bogle's index fund does, or a hedge fund that charges 2 and 20 or even higher, those fees make it very expensive for an investor to outperform net of those fees. And I think more importantly, those are the people that you're competing with if you're an individual investor trying to beat them. And they are well capitalized and have huge resources. I look at what I do now, and it's hard for me to believe I can compete when I'm competing with Bridgewater, who has 100 guys smarter than me focusing on markets 24/7, with all the financial resources and technology that you could possibly imagine. And so what I mean to say is that most investors shouldn't be trying. They shouldn't be trying to beat the market. The best thing about that is beta, which is owning assets collects risk premium. And what I mean by that is if somebody approaches you with an opportunity to flip a coin and you pay 50 if you lose and you receive 50 if you win, or equal payoff whether you win or lose, most of us are going to say, nah, that's not that interesting to me. And so when a government or a corporation or a municipality or anybody else that wants your money today asks you to take on risk, that the investment will depreciate, or it might appreciate, but depreciate or appreciate, and when you need your money back, you may be in a drawdown. For you to take that risk, they have to offer you something. And so it's like that person who approached you on the street. If somebody walked up to you and said, hey, we can flip coins as long as you want. I'll pay you 55 cents if you're right, and you pay me 45 cents if you're wrong. I have infinite capital to bet on that, because over time, I'm going to collect 5 cents a roll, 2.5 cents a roll. Anyway, whatever the numbers turned out to be. The point being that all financial assets that have price risk, whether it's a long-term US Treasury bond or a stock or a Bitcoin or a real estate investment, anything that you decide to spend your money on in which you then have risk, the seller is almost certainly going to have to compensate you in excess of what your cash would earn for doing that. And so as an investor, you're paid to buy and hold. You're paid excess return over keeping your cash in a money market fund to buy and hold. And so that's free money. And now the question is, and this is where we get into diversification, if you have a bunch of people coming at you with money that pays an excess return over cash, how should you choose? Should you be concentrated in pro-growth assets like commodities or stocks, or anti-growth assets like long-term bonds, or anti-inflation assets like long-term bonds, or pro-inflation assets like gold? And so when you look at or TIPS, inflation protected notes, when you look at all the possible economic dynamics, it pays to not make that bet. If you don't have to make a bet on growth or inflation, because you don't know, you don't have alpha. You don't know whether growth is going to decelerate or accelerate from current expectations. You don't know if inflation is, because expectations are always changing. And so saying, I think inflation is going to go down doesn't help you if everyone already has priced inflation to be going down. So it's so hard to have alpha, but it's easier to say, well, if I have this amount of risk in an anti-growth asset, this amount of risk in an anti-inflation asset, this amount of risk in a pro-inflation asset, and this amount of risk in a pro-growth asset, I think, all four of those, there's a pretty good chance you're going to earn a risk premium without taking much risk at all. And that's how I think that everyone should invest. That's how I invest. That's how anyone out there should invest who is willing to hold their money and invest for the long term. And so that's the principle around every type of investing I do. And then the question is, what else? And that depends on whether you have any alpha and whether you're confident in it. And that's, again, very, very hard. I think I have some alpha. I'm not sure, honestly. I know your neighbor Renaissance down the street has some alpha. They pretty much do. Otherwise, it's really hard to determine whether anybody has alpha. Even a 20-year track record, or let's say a 10-year track record of 70% wins, which sounds spectacular, right? You win seven out of 10 years. That nobody does that. Turns out 17% of coin flippers flip 7 to 10 correct calls every 10 flips. So just by luck itself, you're going to find 17 out of 100 portfolio managers that appear to have alpha, but really just got lucky. And so distinguishing whether somebody has alpha, for one, thinking that you do yourself without recognizing the possibility that you are just lucky is arrogant, and likely to result in you failing. Accepting that you might have luck still means for you to have proof that you have alpha, you have to have much longer track record than anybody really does. So I think you have to have a very, and then for the person at home watching this, for them to think that they have alpha in picking somebody who has alpha is equally gargantuan a problem, and just continues to argue for, don't try to beat the market. Just accept that the market provides very nice returns over time.
Well said. That was great. You know, alpha is very hard. And I always like to say, is there such thing as pure alpha? Even Jim Simon's Renaissance Technologies firm, I think, only does 90 to 95% alpha. They're not even pure alpha. And their win rate, I think, is just like in a 50% area there. So that's a heavy quant firm, the top, in my opinion, in the world. And even they don't have pure alpha. It's very hard. And that's why diversification is super important. I always tell all my clients, diversification is number one. And you can do that with many ETFs, as you have shown on Two Gray Beards website. And before we get into the alpha and beta and your pinned tweet on Twitter, which I went through it, I love it. I urge everyone to check it out. The Alpha and Beta Investing Strategies 101. And we're going to dissect that. And we're going to go into the alpha. And before we get into alpha, we got to talk beta, because we got to understand beta first. But before all that, let's go into global macro. Let's go into macro investing, because I want to know, as well as the audience, your global macro overview, what you are seeing right now and into the near future. And I know it gets murkier as we go further out, of course, but what is your overview of macro? Is it disinflation, slowdown? And I saw a tweet from you yesterday. And what are your thoughts on the equities and bond markets?
Sure. So firstly, I guess what I'd start with is when asked that question, you have to start with, what's your horizon? When do you think it is reasonable for your outlook to play out? And then second question is, how do you structure a portfolio to be able to hold your exposure through a period of time that may play out? But then, of course, there's both. Do you have a view that you can support in the next in the horizon you want, and can you hold a portfolio in that way? Because I think people can get confused about macro and think that by talking about something that may take, I don't know, 3 to 5 years to play out, that they can actually invest in that way. And I think maybe some can. That is not where I focus. I focus on things that may play out in the next 2 to 3 months. Mm-hmm. So we could talk about, I have opinion, ask somebody a question and you're likely to get their opinion. But I have opinions for how things might evolve longer term. But I don't ever bet money on them, because the potential for me to both be able to hold a portfolio for that period of time and be accurate is very low. So I'm talking about the next 3 to 6 months. And so I think you have to look back to look forward. And what I would say is that over the course of the post-COVID to current environment, we've clearly seen a initial saving of the economy by significant government spending, handing money to people who supplanted their income and allowed the economy to continue to operate while people were at home. And then immediately after that, the reopening created two real problems. One was everybody wanted to spend, and two is the workforce was, and the global supply chains were not ready for that. And so that created a huge, and what I believe still was properly labeled at the time, transitory inflation. But that's long past. The hot labor market is at least a year past. And the disinflationary pressures of people normalizing their spending, supply chains recovering, and people getting back to work and has solved the supply-related issues. But we still have significant demand, and that demand comes from two places, in my view. One is the sizable improvement in wages that have occurred, which creates income for people. When spent, creates other people's income, which creates demand for them. And that whole wage cycle continues to create inflation, upward pressure on inflation, on prices, on demand stays strong. And so there's still a question of whether the Fed, who has raised interest rates and then kept them on hold for almost a year, raised interest rates rapidly and then kept them on hold for a year, has successfully hit demand enough to reduce inflation back to target. And I think the jury's still out, though the last month really has been pretty good for the Fed, both in terms of growth slowing, jobs getting easy, the market getting easier, and then two very good inflation prints the last 2 days. So it's possible that that inflation has been killed, but in my view, not to the level it needs to, not to the level the Fed is comfortable with, and likely will be harder than the two recent prints show. And so that's the framework I'm looking at. In terms of growth, the U.S. economy continues to be strong. GDPs could end the year in the mid to high twos. We see current quarter GDP above 3. And so there is still quite significant growth in the economy. And so, that combination of disinflationary pressures and growth is actually pretty good for assets. And so you've seen a significant rally over the last, since Halloween of last year. And so the question is, where are valuations? And what I see today is that there's something going on in AI, which is worth focusing on. And then there's the rest of the equity markets. And the rest of the equity markets are underperforming by a significant amount the overall index and are behaving more like a slowdown is in place and are not benefiting from the disinflation. But AI spending is real. There's just no way you can look at what is happening at the semiconductors and say that they're not receiving revenue. They are receiving revenue. They're selling and making a lot of chips, and that revenue is coming from many, but mostly the hyperscalers who are investing in data centers. And they're not seeing any revenue yet, but they have deep resources. We're talking about Google, Apple, Microsoft, Amazon, deep resources that can provide these chip makers, primarily NVIDIA, tremendous spending and tremendous revenue without really needing to tap the private sector for investment. They have the money, so they can invest. And so that's real growth. And the question will become, what price do you pay? For the hyperscalers, they are consuming money that they could have used for other investment in their businesses or share buybacks. A Meta, I forgot them. And yet to see any revenue from it. And so the question for this cycle will be, how long will zero revenue AI generate the type of growth that NVIDIA expects? And I don't know the answer to that. They seem stretched, and the hyperscalers particularly stretched, given they're the spenders and not the sellers. So I look at the overall market and say, AI is real, presumably. I'm going to accept the fact that AI will one day provide significant revenue and productivity enhancement to the world. I don't know when, but it will. If I'm wrong on that, this is a bubble and it's terrible. But if I'm right on that, which I think most people accept, the question becomes, and I think Dan Niles said it well, and he's an expert in this field, that there's a period of time where the investors like Microsoft and Google, et cetera, get brought along with the opportunity. And then there's a period of time where they say, well, we need some revenues, and their shareholders say, hey, we need some revenues. And so that tends to create a down cycle for their investment in chips, which hurts NVIDIA. And so at some point along the path of, I don't know whether it's 2 years or 10 years, but somewhere along the path of AI affecting the entire world's life, there's going to be a pullback. And it seems more likely now, while the overall economy is potentially entering into a slowdown. And so the high level point of that whole rant is that equities seem extremely well priced for overpriced for the potential economic outcomes that I can foresee. Bonds have benefited from this 1 month slowdown disinflationary period of time, and I find it very interesting that the 2-year note, for instance, is priced basically where the Fed says its rate path will be, which they've just announced would be basically 5 cuts over the next 2 years. And that doesn't price in much economic weakness. So to me, short-term bonds are fairly attractive. The question becomes, does it make sense to buy a 2-year at 4.80 yield versus a 10-year at 4.25? And that brings up the second point, which is over the past couple of years, the entire effect of quantitative tightening, which is the Fed reducing its balance sheet, has been financed by the US Treasury issuing T-bills. And T-bills do not tax. Remember, we talked about beta. T-bills are really very close to cash substitutes. The worst case, you buy a 1-month T-bill, a 4-week T-bill, or even a 12-week T-bill, you get your money back in 12 weeks. And you're never going to lose capital. So there's just huge demand for that without any impact on overall markets. But if the government was only issuing 30-year bonds, to get people to play the 30-year game, where not so long ago, 2 years ago, those same 30-year bonds fell 35% in a year. That takes a lot more risk taking than the market may be comfortable with. And so for the last couple of years, quantitative tightening, which is the Fed's reducing its balance sheet, has been financed with bills. And that's created a oversupply of bills and an undersupply of coupons, such that if the government continues at its current rate of issuing bills and floating rate notes, which are essentially the same thing, they'll be running about 25% of the national debt in short-term money. And that's a very large amount relative to any historical period, except when the the country's been in a significant recession. And so while the economy is doing great, we're running at extremely high levels of bills financing. And that's been supportive of assets. And over the next, for as long as I can look forward, frankly, and again, I tend to only look out 3 to 6 months, but I'll look out a couple of years and do the analysis. We're talking about $2 trillion of new coupon debt issued every year for the next couple of years, which will significantly reduce, if they do it, will significantly reduce the amount of bills outstanding and increase the amount of risky coupon bonds outstanding. And so when I look at that supply, I say, the 10-year, which is going to get all this issuance, is giving me 60 basis points less current yield than the 2-year. I just prefer the 2-year. So that's the bond market in summary. The equity market in summary is stocks are overall fully priced with relatively high multiples and extremely aggressive earnings forecasts. And so when I look at those two things, I'd like to be long 2-year bonds and short equities.
Wow, you've really unpacked that very well. Thank you for breaking that down. Now, we've definitely heard about the Treasury, the short-term bills, offsetting the QT, and obviously there's plenty of liquidity in the system. We see the markets running, and the valuations is very important. I tend to be more of a fundamentalist, so I look at the valuations, and it's very concerning. A lot of times these new themes, now AI is amazing. You're an engineer, you know about the AI and what it can do to businesses and people's lives. However, these trends tend to run a little bit ahead of themselves sometimes, and they run on a little bit of hype. And so maybe we're in that stage right now. People are over exuberant about what AI will bring, and we haven't seen the hardcore numbers yet. So they'll probably go through that phase. And the question, of course, is when. So we don't know when, but so you're bearish equities, you're long the 2-year, and I would say bonds, long-term bonds, like say TLT, you're bearish on. Is that correct?
Yeah, I mean, my exact positioning is short stocks, the equivalent of TLT, and gold. I don't have an exposure on the 2 years right now. I sold some on this rally, and I'll look to buy them back if they cheapen. There is a bit of disinflationary exuberance as well in the markets the last few days.
Yes.
That as a trader, makes sense to take profit on 2s, but that's how I'm positioned at the moment.
Great. Now, this yield curve inversion, everyone talks about it being a predictor of recessions. There's a lot of different takes on that. It is the longest inversion I believe we've had. A lot of people talk about bull steepener, bear steepener. I tend to think we could have a bear steepener. I think I saw you tweeted something about bear steepening. Could you tell us your thinking with this bear steepener and what you foresee a potential of it occurring?
Right. So the question that I think about when I think about what the yield curve is going to do, whether it's steepening or bear, bull, steepening or flattening, is what are the various drivers? And the front end of the yield curve is almost entirely driven by the Fed's reaction function. They set the short-term money market rate, and 1-year bonds can't get far away from that. 1-year yields, and 2-year yields still can't get very far away from that. And so right now, it appears that the Fed is comfortable, is not confident that inflation is declining to their target, is comfortable that the economy is able to operate without job losses at the current Fed funds rate. And so they're pretty much on hold and have said they're on hold. And so for me, that means the 2-year note is very data dependent. And what I mean by that, not just sort of monthly fluctuations, but either a significant slowdown that's disinflationary, a significant slowdown where inflation remains high, or a no slowdown, continued growth, or possibly even accelerated growth, and sticky inflation, or disinflation. And so when you look at those four things, the ones that are going to cause the Fed to have a big change is growth and inflation rising, or growth and inflation falling. Where they really get in a sticky problem is when inflation, the best thing for markets, let me start by that. The best thing for markets is disinflation and continued strong growth. That's what we call Goldilocks in the business. Economy grows, people are wealthy, wages are good, everyone has a job, they are investing passively and actively, and there's no inflation. That can't be better. And that's mostly what we've seen in terms of market pricing, is expecting a Goldilocks. Disinflation with weakening growth is a typical recessionary response. And in that case, I would expect 2 years yields to fall a lot. If we have continued inflationary pressures with decent growth, the Fed's going to hike. Now, that's not expected at all. It's possible, but it's not expected, and it's not my central view. But that is a possibility. In that case, we're going to get more inversion because the short-term yields will rise. Where it gets real sticky and really bad for markets is what people like to call it stagflation. It's not that. Stagflation is very bad growth and very high inflation. But heading in direction of that, which is falling growth and sticky inflation, that's where the Fed is, we'll see which side of the mandate they operate under. And let's assume they stay where they are in that case. So those are the two things that are going to drive the bull case, which is a disinflationary recession, or the bear case for the 2-year, which is a continued growth with sticky inflation. Right now, markets are priced expecting those to be a coin flip. That doesn't have much edge in it. On the other hand, long-term bonds are pricing a disinflationary recessionary period and are not pricing continued sticky inflation and continued decent growth, in my judgment. And so I think long-term bonds are asymmetrically priced where short-term bonds aren't. So what does that mean? I think long-term bond yields are not going to go down at all from here, unless the 2-year goes down in yield a lot. So either there is a bull steepener, 2-year yields down, driving long-term yields down a little bit, steeper curve, or long-term bond yields rise, and possibly more inversion occurs. But it's unlikely, given the Fed's is not really, because it's going to really have to see inflation accelerate for them to raise rates. So I sort of like the 2-year because it doesn't have much downside and has a lot of upside. And I certainly don't and so I think it's a little asymmetric in that way. And I really don't like the 10-year because I don't think it has any upside, and it has, except when the 2-year does really well, and has a lot of downside. And so the most natural thing would be a bull steepener at this stage, given the economic data. But the economic data is noisy. And so we're all going to have to wait and see if these two negative inflation prints and the prior, late May's early June's job reports were pretty weak. So, that leads everybody to think a bull steepener is on the way. A bear steepener will only happen if inflation is high, economy is strong, and the Treasury supply creates a sell-off. That will create bond yields rising faster than short-term yields. That's what I thought 6 months ago, 9 months ago, when this actually began happening. But it seems like that is not in the cards in the very near term.
Interesting. Oh, that's a great case you have there. Thank you for taking us through your thinking. Now, growth and inflation, those are two very important elements that belong together and part of a portfolio construction for long term. Is your central tendency to think that core inflation, core CPI, is stickier and that it may not come back down, and maybe the threes are like the new twos, and that we may actually stay at this higher level, and this short term might have just been a little noise, and that it may stay at this level while we have weakening jobs and weakening growth, so we could actually be higher inflation and slowing down of growth. Plus, a great economist, Dr. Steve Hanke, who's a mentor, talks about the contraction of the money supply, the fastest contractions in the 1930s. And he says that a recession is baked in. And that will be later this year. I think he references next year. So obviously a recession is a slowdown in growth. Do you think of that into this year, into next year being a higher probability possibility?
Yeah, so since COVID, for a couple of years, I was labeled a perma bull. I'm not labeled that anymore, quite the opposite. While I'm negative on stocks and have been for a few months, call it 9 months, 7 months now, I've been pretty bullish on growth and fairly realistic on inflation coming back due to the transitory aspects. And my view was that it was going to take a bear steepener where long-term yields have to once again rise above 5% for growth to really, for inflation really to be killed. And the reason why is because I expected that demand in a wage-driven cycle has to fall, will only fall with higher unemployment. And so, as I think about it today, that's still my basic point of view, which is that inflation will remain sticky above target and require action by the central bank if unemployment rate stays around where it is. And that only if we see meaningful demand destruction due to unemployment increasing, also immigration slowing, because if immigration continues to provide growth, even existing worker job loss won't be a big deal. So we need fewer people to be able to spend on fewer goods and services. The only reason why they can't spend typically is they run out of credit, they lose their job. Credit usage is pretty low. I mean, there are cases where certainly people that are in the worst possible shape in the economy are struggling with difficult credit conditions. But by and large, the rest of the economy has excellent balance sheets, very little debt, and their assets are, whether it's a 401k for a union worker or a portfolio for a wealthy older person, people are flush with money and corporations are flush with money. And so it's not going to be a debt crisis that's going to kill demand. It's going to be unemployment, less wages. How do you get less wages? Well, the way it typically works is either a debt crisis, which again isn't happening, results in a economic downturn, or stocks fall. And when stocks fall, people's wealth declines. People's wealth is, if people are less wealthy, they're less inclined to spend. That less spending results in less earnings for companies, and that less earnings results in cost cutting, which is firing people. And then that cycle results in lower aggregate demand. And so what I thought was going to have to happen for stocks to actually start falling is bond yields to rise above 5%. And that's still my expectation, that we could keep going without a recession for many years if long-term bond yields don't rally. But I could be wrong. Maybe short-term rates at 5.25%. The Fed tells us this almost every meeting, except oddly enough, the last one, that conditions are restrictive, and they do that by looking at the short-term interest rate, which is their lever. If in fact short-term interest rates at 5.25 and long-term 10-year bond rates at 4.25 are in fact restrictive, stocks will fall, people will lose their jobs, and inflation will be killed. I just don't believe it. I don't believe that when I look at stocks at all-time highs, when I look at speculation across various high-risk assets, that the economy is restricted at all. High home prices. I don't see the economy being restricted at all by current interest rates. And so if it's not being restricted by current interest rates, and no one's going to lose their job, and that will likely keep inflation stickier for a lot longer. And if we accept that high inflation, we can avoid a recession. And so the question is, will the Fed get the message? And I think honestly, this most recent FOMC from yesterday showed some hawkishness for the first time in many, many months. And it's possible that hawkishness reflects what they actually think and makes them nervous that financial conditions are not adequately tight and that they haven't killed inflation. But the world's a crazy place, and it's certainly possible inflation magically declines.
Yes, that's true. Who knows what can happen? Anything is possible. But yeah, you referenced the income-driven cycle, which I know Bob Elliott, who we love, he was a guest on here twice, and he talks about it. He's a brilliant macroeconomist and a great teacher at Bridgewater when you guys were there.
When I joined, Bob's was just the next cubicle over. And I think he was 25 at the time. I've learned so much from Bob over the years. It's really, he's a phenomenal guy.
Oh, and super great guy too. Very sweet. And he's generous with his knowledge as well. And we're grateful to have him on Twitter. And yeah, with this income-driven cycle, it's much, much slower. So who knows, this long-awaited recession could be dragged out many years. We don't know. And you and I, as traders, we like to look at the short term. That's where the opportunities are in the next 2, 3 months, 6 months, maybe up to a year. So definitely on that. Okay, so the Fed, you mentioned the Fed. Let's get into the Fed. A little more hawkish yesterday from Mr. Powell. What are your thoughts on what your expectations are, what they will do, and what do you think they should do? I'd like to know your thinking, Andy. Do you like rates at this level where they are? Do you think they should be higher? Are you in favor of rate cuts? There are economists that are all over the board with this one. I'd like to know what you're thinking.
So for well over a year, I've been an advocate for as you heard, perhaps, the way I think the current economy works is that it is very insensitive to changes in short-term interest rates. Very few people borrow at the short-term interest rate. So when that rises, unlike Europe, which has, the rest of the world, which has mortgages that are set on the short-term interest rate, the dominant amount of debt held by homeowners, well, households, is mortgage debt. That's 30 years in expiry. There are very few public corporations and private corporations for that matter, that have long-term funding that is floating rate. And if they do have long-term debt on their books, chances are it's at very low interest rates when they initiated it. And so they have a great deal. They're paying very low interest for on their debt. And so to me, that means that the short-term rate, which typically works by raise short-term rate, banks who are levered pass that on to their clients who are floating rate clients, and they're levered, and that creates what is typically a credit contraction. In this case, banks are not levered. They are in the best shape they've been, principally because the government forced them to be in highly capitalized shape due to the GFC. And so they're in great shape. Their clients are not exposed to floating rate. Now, another thing is the type of economy we have is people are buying services, and services are not capital intensive, neither for the person who delivers the service nor the person who receives the service. When you're paying for something monthly that you can cancel at any time, you're not exposed to changes in interest rates. Where you are is if you are buying a car or a home and have floating rate exposure. And so when you look at the sensitivity to what we spend our money on today, the private sector is in great shape and is just very insensitive to changes in the short-term rate. Does that mean it should be higher? No. There's some who say, and I think they're right, particularly initially, there's some who say the first hikes from 0 to 5 were inflationary because no one borrows at that rate, but many people lend at it in that they roll their T-bills, and now all of a sudden they're collecting more interest than they have, and they have more interest income. Now that may have been true, but I look at things in a rate of change basis, and all the people that had their income essentially go up 5x are not seeing it go up at all anymore. It's high at 5% interest rates on their T-bills. Their income is high, but their income growth, which is what matters, is static because interest rates have stabilized at 5%. They're not rising. Now, if interest rates were to go up 6%, they'd get 16% more income that they could spend. And so that would have an impact on the economy. So I get the idea that the first 500 basis points of tightening was inflationary and pro-growth. I don't think it is anymore. And now the question is, what else happens? And the bottom line is, I think what matters to this economy is long-term interest rates, because every asset, stocks, homes, bonds, are all impacted by the long-term interest rate. And that means our wealth, our assets, what we own is impacted by long-term interest rates. If they rise, our wealth falls and our desire to consume falls. So I think this economy needs higher long-term interest rates, not lower long-term interest rates. And I'm sort of indifferent on the short-term interest rates because I don't think it does anything. The Fed, on the other hand, thinks it does everything. They have ignored the idea that quantitative tightening is tightening. And only once, when interest rates actually were over 5%, did they even mention long-term interest rates as a tightening mechanism in September of last year. as doing some of the Fed's job for them. So what I'd like to see is the Fed engineer higher long-term interest rates. Unfortunately, they handed that ball to the Treasury because quantitative tightening, which is the way to get selling your bonds, reducing your balance sheet, is the way to get higher long-term interest rates. But the Fed chose to do what's called runoff, in which maturing bonds get paid off. And then they handed the issuance of new bonds that pays for that maturity to the Treasury, and the Treasury issued bills. And so the mechanism of QT, unlike the UK, where the UK actually sells 30-year bonds to the marketplace, demands them to pay up for them, which causes yields to rise. The Treasury has muted that. And so in my personal view, for years now, I've been saying that I'd like the Fed to sell their SOMA portfolio in the marketplace instead of letting it run off and cause long-term interest rates to rise. They have been unwilling to do that, and it's clear that they are not going to do that. They're actually reducing quantitative tightening. And I think that's because they fear the consequence of long-term interest rates rising, because long-term interest rates are a chaotic partner to be with, meaning sometimes interest rates, if they get high enough, can really cause things to break, long-term interest rates to break. And we saw that in the UK in 2022 when they had their insurance fiasco, their Truss budget busting thing, which caused her to have to resign and caused a blow up in the insurance schemes there. And we saw that again last fall when the bond market exploded and the Treasury acted. And so I think they're very fearful of having long-term interest rates rise, but I honestly think that's what's going to cause inflation to fall. And so they're stuck with sticky inflation. Now, do I think that will mean I think what that'll mean is they'll just not cut for long and will just hover, circle the landing ground forever until after years of 5%-ish Fed funds rates, finally long-term bond yields rise enough to tighten. And so, that's sort of my Fed outlook. You want me to, I don't care what they do with the front end of the rates curve. I want them to have the back end of the rates curve rise, because I think that'll kill inflation, which I think is the most important thing that policymakers can do in this day and age.
I like that perspective. Very well thought out. I know on Twitter you went from higher for longer island, and then I think we touched upon soft landing island at some point, and now we're in circling for longer island. And I guess this is what you're referring to, and I think you're the host at that island, right?
Well, what I'm doing now, so as I said, I was very bullish on the economy and thinking inflation would be stickier and the Fed would have to be higher for longer. And now everybody on the planet said, yes, we accept the Fed's going to have to be higher for longer. They priced in 7 cuts in January, and now we have 1 cut priced in. They've come to that island. That island is crowded. So I left, and there are only 2 other islands. There's Soft Landing Island, which is where the equity people are. And there's Recession Island, which at this point is empty except for some doomers that populate Twitter. No asset markets are expecting a recession at this stage.
That's so
now, what I am doing, as I left higher for longer island, I went into the economic slowdown sea. And I'm circling in that sea, looking for a place to land. And I think it's going to end up being, I don't believe soft landing is in the cards. It can always happen, but I don't believe, and certainly it's worth trying to land on soft landing island because that's literally the Fed's mandate. But I just think it's extremely hard given the pressures that are facing this economy after $6 trillion of spending and a very tight labor market. But who knows? More likely after circling for longer in the economic slowdown C, I'll end up at Recession Island, but the journey may take some time. Now, gun to my head, I think we're going to see an economic slowdown by the fourth quarter or first quarter of 2024, 2025. But we'll see.
Circling for longer. I love that. Very creative that you get with your theories. And I like that island. I think that's
imagery thing.
Very nice. You combine the right side of the brain with the left side of the brain. I like that. And you add some nice imagery there. You're a great follow, Andy. I urge everyone to follow you on Twitter. So I want to talk to you about the real estate market. You talk about long end, the long duration, and the importance of that being higher. And what about the real estate market? A lot of people are locked in at 2.5%, 2.8% mortgages. We have our area, historical low inventory. My friend is a real estate agent here. He's like, I've never seen it like this in my 30 years of being, even 2008 wasn't like this. It's like, this is crazy. So now mortgage rates around 7.5. People are not selling their homes because they don't want to pay 3-4 times more for less of a home. What do you say to all that?
I'm going to take a pass on this one. I wish I had something to add, but it's like one of those things. You ask somebody for their opinion and they're going to give it. I have no informed opinion. My only higher level view is that housing construction, when is an important aspect of the economy, and it needs to be followed to understand whether the economy is going to slow or not. But in terms of prices, I wish I had a view. I don't.
Thank you so much. I appreciate that. That's what we value about you, is that you're very direct, you're very honest, and that's a very noble quality. So thank you for that. Okay, so debt, the pink elephant in the room, massive fiscal spending, 35 trillion now, interest expense, about $1 trillion a year. And you and I had a conversation the other day through Twitter, and we were saying how even if the Fed lowered rates, and what's the difference? 5% interest rate right now on that, you're only going to lower it a little bit. They're continuing to spend to no end. It's unsustainable. Are you concerned about that leading to further fueling inflation or leading eventually to a monetary destruction? What are your thoughts on all that?
Yeah, I would say that fits into this idea of futurist thinking, which is something I have fairly strong views in terms of the framework, but in terms of predictions, I'm not going to be that good at it. But I will say one thing, which is in terms of the short term, as we said, what would happen if the Fed tomorrow reduced interest rates to 4%? So what would happen is $6 trillion of our debt rolls every year. And so relatively quickly, $6 trillion of debt, which is now paying 5% interest, is going to pay 4% interest. Okay, that sounds good. That's going to be a $60 billion reduction in our debt financing costs, that $1 trillion number you mentioned. Okay, that's fine, I guess. $60 billion on a $25 trillion GDP is irrelevant to just about anything in the economy. Truly irrelevant. And so I don't care about that. I just don't. And if, by the way, if they increased interest rates by 100 basis points, that would have the same effect for another 60 billion. Now, each year, we have $23 billion of, in terms of total public debt, we have another 20-ish billion dollars of, just for round numbers sake, of public debt. And, some of that matures each year. And some of that would be impacted. And so maybe $1 trillion would find a lower interest rate. But remember that the current interest rates expect interest rates to fall to 4%. So it's not clear that the 30-year bond is going to fall 100 basis points if they change the bills rate by 100 basis points. So when you look at that, it's just not going to move the needle to change interest rates to make our debt situation more sustainable. The number one thing that impacts the ability for us to sustain our debt is how much new debt, how much new money, new primary deficit we create. And primary deficit is basically the deficit without the interest. The primary deficit is determined by how much the government wants to spend on all things that aren't interest. And we're spending, I think the primary deficit is expected to be, below $1 trillion, obviously. I think our total deficit is expected to be at 1.6 trillion. So let's say it's roughly 600 billion. That's a lot of money. We should spend less. But can we? Is there anybody that expects that either any of the potential alignments of the House of Representatives, the Senate, and the executive office is going in November is going to cause a deficit reduction to occur, a primary deficit reduction to occur? I think the odds of that are, it's never happened before. Everyone campaigns on deficit reduction, but everyone in office increases the deficit from Reagan on, regardless of party. So I'm a cynic in that way. I think the best thing would be a split house and a split government like we have now, in which there's some checks and balances. But if we end up with a sweep on either side, the deficit's going up. The primary deficit's going up. And so now let's step back and say, okay, so does it matter at 35 trillion? Does it matter that our primary deficit is growing at 6% of GDP? Well, no, not really. Because our bonds are able to be sold at very attractive prices, and most of the buying of our bonds is paid for with the money we spend in the economy. The public sector, when it spends money in the economy, that money, gets handed to certain people, and those certain people then spend it or save it. But regardless of whether the initial person gets it and spends it or saves it, ultimately all of it gets saved, and all of that gets bought, is used to buy treasuries. So I don't have a strong, and we've seen many economies, well, Japan in particular, can have much higher debt to GDP. And ultimately, what happens when you have this, and what will happen to us, is the purchasing power of real goods and services will decline as our debt to GDP rises. And either we pay down our debt. So what happens? When you take on new debt to GDP, the private sector benefits through economic activity, enhanced economic activity. So current voters are being benefited by our increase in debt. It comes at the expense of future voters. And not at the literal expense, but at the expense of their future standard of living. And so ultimately this gets paid back with our stuff getting more expensive, and thus our standard of living falling, not in absolute terms, but our potential standard of living increase underperforming in a period of time in which debt's getting paid back, or some artificial cap is put in place such that we don't increase our debt. At that point in time, those future voters who voted for that, will they? I don't think so, but will they vote for it eventually? Or will it get kicked down the can again, down the street again? Who knows? But eventually, somebody's standard of living will decline relative to current standard of livings. And that's inevitable, but it's also not immediate in any sense of the word.
I agree. I think it's a eventual, but it's way long ways away, and we can kick the can much further than many people think. So it's something eventually, but not anytime soon, and certainly won't affect our investing if we're investing the next 3, 6, 9, 12 months. So I want to focus on investing. I think that's a great topic, and that's what you focus on. And that's the purpose of all of this, is how can we, we're going to try to create alpha, generate alpha, but how can we at least have smart beta, like you reference on Damp Spring? And I want to get into the alpha and beta, but I have to ask you about your tweet. You have such cute tweets. They're really cool. The two galaxies. I don't know if they still applying, because they may have
Sure,
changed,
they
but
do. Absolutely.
okay, you got the two galaxies, okay? They're really pretty, purple, I like it. And you have SPX, you have the date of 6/28, that's the end of this month. SPX 5570, SPX 4975. Why? I have to ask Andy, why? Why that big difference, and why of each side?
Right. So so I believe there's a lot of people on Twitter who believe a lot in things like gamma and vana and charm and the impact of the options volatility surface. And this has been enhanced by data expiration options that care a lot about that stuff and believe it can predict market prices. I've spent most of my career building that type of stuff. Like, I've run equity derivatives since the mid 90s. We were using Vanna and Charm back then.
Wow.
It's nothing new. This is not new. Nobody out there tweeting who started in 2008 invented a thing. So these are not difficult concepts. However, in my experience in using these techniques, the one thing that was the most significant to markets is, and we're seeing that oddly enough in, you got to bring Roaring Kitty into this, but oddly enough in Roaring Kitty's 20 strike calls that expire next Friday, very concentrated strikes have a real pronounced impact on equity prices if you're within range of those things within days of their expiration. I've personally seen many cases of what we call PENN risk, in which a very concentrated strike held by someone who is long an option, who then dynamically hedges that by selling, let's say it's a call, selling equity when it goes up and buying equity when it goes down. That activity dampens the volatility and causes the stock to go to the strike of the option. So there's $20 billion of June 28th, 5570 strike on the SPX outstanding, the biggest concentration of any single player's options in the market every quarter for many quarters that have occurred. And there happens to be one at 49.75. And so it's been my experience, and sometimes it works, sometimes it doesn't. But on more than, I think, 5 or 6 occasions over the course of the last 3 years, this particular 3-month option roller, which is the mutual fund run by JP Morgan called JHQEX, has had has had a impact on the market. And so I throw it out there as a meme to mention, those who know what it is know that those are the strikes, but it's also come true fairly frequently. And so I think if we do get continued strength in the equity market, which, again, today we're up, we could squeeze up to that strike and then spin there by month end. On the other hand, if we were to sell off, that other strike may cause it's actually a short option position by the delta hedgers, could cause an acceleration down to that strike. And through that strike, frankly, that strike is actually, instead of a black hole, I was really attempting to use a black hole for that meme, which is hard because a black hole you can't see, but it's actually more likely that if we go to that strike, we actually will run through it. And so what's of course going to happen is we're going to end up in the middle, but it could be an influence and something that people should be aware of, that the closer we get to the black hole, the more likely we will end up there on that day.
Wow. It's almost like magic, right? Option flow, and you've been doing options for so long before it became so fashionable and everyone's talking about it on Twitter as of late. Andy, do you try to read the option flow? Do you look at this massive inflow of certain strikes, and do you invest tactically accordingly based on this information?
I'm aware of it. I have some systematic indicators that are particularly associated with momentum that use some of those things. But to be honest, it's not gonna, the impact of a particular OPEX week when you're thinking about a 3-month horizon and you're going to have 3 OPEX weeks during that period of time isn't part of my process.
Yeah, it can be noise, and there's a lot going on.
Well, I think I have to, particularly if I have a short dated, if one of these 3-month options is expiring next month or next week, then I'm more conscious of it in terms of what could, how I exit or enter into that, a new trade, roll that trade, whatever it might be. But no, I don't place a lot of emphasis on, frankly, it's because, again, it's a matter of alpha. Like, while people that I worked with and myself helped invent this type of stuff, the people that are doing it on Twitter, well, assuming they're doing it in real life on Twitter, but certainly the people like Citadel that are doing it every day and are totally wired with information on this topic, have way more edge on that particular signal than I could ever possibly imagine building. So I don't do it.
Yep, it's about that edge. It's very difficult for retail investors to get that edge.
Right. If you don't have edge, there's 2 things you can do. You can try to get it, which is very hard, or you can accept it. And if you accept that you don't have edge in a particular thing, you have to then judge whether you have negative expected value transacting, or you don't know which way the edge is, but you don't care because as long as it's 50-50 odds, all it does is create risk for you. It doesn't create negative return. What's bad is when you enter into a market where somebody has edge against you.
Yeah, absolutely.
And that's like any, a stock picker. Nobody on the planet can understand everything about a stock, but the market does understand everything about a stock. So if you have 20 things that the market knows about a stock, and you only cover 10 of them, that doesn't mean you don't have an edge. But you have to judge whether the odds of the things you don't know about having a random outcome to you or are stacked against you or stacked for you. You don't know much about them. So I think the basic expectation when you don't know everything, and no one knows everything, the base expectation has to be that it's just a symmetrical risk that says, okay, I have this edge in these 10 things. I have 10 things I don't know about, and those 10 things are random, but they could all go against me, or they could all go for me, but they're random. That means I have risk. Is the return satisfactory to the risk? And if it's not, you don't trade.
Exactly. It's always about risk adjusted returns, and we have to balance the risk with reward. I want to go right into your pinned tweet and take that, the alpha and beta investing strategies. And at Damp Spring, you specialize in the DS alpha and you have smart beta. Alpha is the holy grail. We're always searching for alpha. And sometimes I wonder, is the alpha really just beta in sheep's clothing? So we don't know if it's disguised or not. But so in order to understand alpha, I think we need to get into the beta and understand the beta. You talk about smart beta, and we may be in a stagnant economy. We may have a slowdown upcoming. How do you find attractive anti-growth assets? So I want to ask you to explain smart beta and how you find those attractive anti-growth assets, please.
Right. It's funny you mentioned how difficult it is to know whether you have alpha. One of the best ways to know that you have beta is to be passive. If you don't do anything in markets and you just hold assets, you have beta. It may not be good beta. It may be badly balanced beta. It may have exposures that can hurt you. I would prefer you have a balanced beta like I described earlier. But if you don't do anything in markets and all you do is buy and hold, you have beta because that's the only potential return you have. And that is that you collect the risk that people pay you for holding risky assets. When you start trading, when you start tweaking your holdings, go from underweight to overweight to underweight to equal weight, or go from long to flat to short, those decisions are decisions that are what I would call alpha, which is decisions that one would only do if they had a expectation that by doing so, they would make excess return, meaning that they had better odds that by switching out and back that round trip, that they're going to make money in an absolute sense. And so smart beta is just beta with a little bit of alpha, in that here I have a balanced beta portfolio, and I'm going to tweak it every once in a while for various reasons. And that's what my smart beta is. And it's alpha, it's beta, plus a tiny bit of alpha. Now, I think the thing that you said, which is 100% right in my view, is that most people who say they have alpha really have beta. And so the question is, how do you determine that? And I think that's, again, track record is a problem because they tend to be short. So for me, the holy grail for showing that you have alpha, at least showing that you might have alpha, you still may just get lucky, right? Because most people just get lucky and that's fine and consider it alpha. Is that your portfolio returns over time are not correlated to a beta portfolio. Use whatever benchmark you want, 60-40, risk parity, anything that's diversified alpha, my own beta portfolio, whatever you want to use, and say, is my alpha portfolio correlated to my beta portfolio? If it is, for instance, if it's meaningfully positively correlated to your beta, you may have a little alpha, but you have mostly beta. And so, for example, a fund that is a long-only equity stock selection fund that outperforms the S&P. Do they have alpha? Because they made absolute returns, no. What they have is beta because they are really the S&P, but they beat the S&P. How much did they beat the S&P? Okay. Could that return be replicated by just being levered long the S&P? Once, meaning you are assuming the same risk as being long this other thing. If something goes up 20% and the S&P goes up 10%, and your P&L would perfectly track this other thing that claims to have alpha by levering the S&P 2 to 1, that's not alpha. That's just levered beta. And so there are lots of ways to take people's portfolio and determine whether they have alpha. But even if you determine they have excess return on a risk-adjusted basis, uncorrelated to beta, you still don't know if they're lucky. So the first step is, what's the benchmark? Outside the benchmark, did they outperform the benchmark? By how much did they outperform the benchmark? Okay. Of that outperformance, how much did that correlate to the benchmark? If it's uncorrelated to the benchmark, there is a chance, and what I mean, zero correlation to the benchmark, there's a chance you have alpha, but there's also a chance that they were lucky. So not only do most people, and what's the big problem with that? Like if somebody charged me no premium in fees to be an active investor, I'd say, well, I'd like to see that you outperform, but hey, that's pretty cheap. But when you layer on 2 and 20, or even 60 basis points relative to a passive index fund of 10 basis points or 5 basis points, is it worth it net of fees? And I would say most of the time it's not. And so once again, it just says to the regular investor, and it's something I have to ask myself every single day, do I have any alpha? Does this strategy have any alpha? And if it doesn't, you're better off, unless it's a big diversifier, you're better off having just pure beta. The chase for alpha is, in my view, mostly futile.
Yeah. So it's like a mirage. You're always searching for it. And when you get closer, you're like, is that really alpha? No, it's just beta in disguise. And, I like to think of alpha as being on a sliding scale. I don't think it's pure, in my opinion. I think it's nearly impossible to find a completely uncorrelated pure alpha, but you could probably have, maybe you could, like, Renaissance technology, you can have majority alpha. Like momentum. I want to talk about examples of uncorrelated alpha streams. There's the statistical arbitrage. I think that's what Renaissance does with the quant computer models. Then you have equity market neutral, selling liquidity premiums, momentum. Are any of those things that you dabble in, that you invest with? And also the momentum one is the one where I try to search for alpha. I always feel that with momentum and you actively trading, you always have that beta because it's reliant. Say you choose an individual stock or even an ETF, it's always reliant on the financial market and how it performs. Because no matter how great a stock is, let's say the Nvidia, all of this, if the market tanks, I mean, that's going to go down too. Maybe it'll go down less,
Sure.
but it will have some correlation. So I always think of that. What are your thoughts on all those different uncorrelated alpha streams?
Right. So you mentioned StatArb. That seems to be still have alpha, at least the best providers with Renaissance quality have. But I still take one caveat to that. Market participants pay various participants money. And one of those major things is liquidity providing, meaning market makers extract a living from the markets. They used to do it with high commission and no principal risk. Now they do it with paying commission to order providers and get it through arbing them, taking bid offer spread that is less than the commission. And so whenever I think about the strategy that someone has, I wonder if they're liquidity providers. And so stat arbs at some level are also, they both consume. So when you ask questions about people's black box, it's important to ask the right questions. How many times do you you buy on the bid? How many times do you sell on the offer? How often do you trade? The higher somebody somebody trades, the more likely that they are providing market maker services.
Mm.
Now I'm just giving you general guideline type things. Now, the second thing is there are a whole bunch of strategies. Long-term capital is a great example of that. But I did a bunch of them myself. Convertible bond arbitrage, capital structure arbitrage, any sort of relative value trading strategy in which you provide, which I think you described it as collecting a liquidity premium. If you buy something illiquid and hold it on your balance sheet and sell something liquid as a hedge, I consider that beta. And the reason why I consider that beta is because while it's market neutral and thus not correlated at all on a day-to-day, week-to-week, even month-to-month basis to beta, like liquidity illiquid premium investors can make money in up and down markets. Perfectly fine. Consistent money in up and down markets. Unfortunately, every one of those strategies has a huge asymmetric drawdown in the same exact time. And that is when there is a stock market crash. You look at every convertible bond arb, you look at, some are actually caused by, like long-term capital had it itself caught its unwind, once it began unwinding, caused a market correction. But by and large, mortgage arbitrage, credit arbitrage in 2004, there's many cases of equity markets falling at the same time that these illiquid asset owners unwind as well. And so if you think about real diversification, real alpha, the worst possible thing you could have is when your beta portfolio is sucking wind, so is your alpha strategy. That's when you need the diversification. You don't need the diversification week to week and day to day. And so market neutral strategies broadly, the thing you described as illiquid liquid arbitrage, to me, are uncorrelated when you don't need them to be and correlated when you do. And so to me, I consider those strategies beta. Whether I'm using the right label or not is sort of irrelevant to me. What matters is if it's truly a diversifier, it better be a diversifier when you need it to be. So anyway, that's what I would say about those strategies. Now, the last thing you mentioned is momentum. And so the momentum strategy to me looks like this. It's purely market timing. If it is truly a momentum strategy, it should be short when markets are falling and long when markets are rallying. So I'd like to know that it is. If it isn't, it may be, for instance, say it was only allowed to be long. That would concern me relative to it being real alpha versus, no, it's not. It's good if it can avoid drawdowns and still never be short, but that's not the pitch. The pitch is positive or negative momentum, it makes money. And it is usually these strategies are diversified across asset markets. And as Jim Cramer likes to say, there's always a bull market somewhere. There's always a bear market somewhere as well. And so if you're really doing diversified momentum strategies, you probably have multiple assets, and those should be on average flat, neither long nor short. And so now the question is, does momentum have alpha? Just broadly speaking, does momentum have alpha? And for me, it does. And it does for human nature reasons that are timeless and universal, as Ray Dalio likes to say. And he, I'm sure Bridgewater signals have momentum in them, though I've never seen them, at that level. I'm not in a circle of trust. What happens? Well, news comes out that is not well distributed, and it becomes distributed over time. And people seize on the news, the market starts rallying. Momentum strategies pick up on the beginning of a trend and hop on. And where they get off, either through risk management with trailing stops or through other signals that show that flow has gotten to a point where now the last person to know is finally in, that's a human nature outcome. And to me, that has alpha. And, you look through Cliff Asness papers at AQR, you look through most papers that are written that are, practical, real implication of momentum strategies. It's timeless and universal. Now, does that mean it's easy? No. It just means it's timeless and universal in that people are driven by that. And so, yes, I believe momentum has pure alpha, and if done right, is uncorrelated to market returns.
Wow. Wow. Thank you so much. It's amazing. Your insights with alpha. You should write a book on this. This is just amazing stuff. The human emotion, the self, that's always the challenge. I think it's the behavioral economics. You talk about decision sciences, the biases, the heuristics. It's importance of pattern recognition and identifying contrarian patterns early. And it's like that, we can see that with the momentum, but then it's having that discipline to sell and to end that trend, to get out of that trend before it reverses on you. So Andy, I have to turn it to you as a very experienced trader over 35 years. How have you balanced that?
Narrow the question a little bit.
How are you able to remove the emotion in the decision-making process? Now, we all have emotions, we have feelings, we feel our decision, like Denise Shull, she was a guest here. She says how we feel, but how do you remove it from any impulsiveness in the decision-making? And how do you know when to leave a momentum and break away from it and not overstay your welcome?
Yeah, so that's what I was saying. Let's just step away from momentum and deal with the emotional thing. That's what I want.
Okay.
The answer to that is systematic. To the extent you can systemize, you do. It's very hard. And so I am exposed to emotion. And so for me, that's been always about risk management and not trading too large. And not always. Sometimes I've done badly and not been able to handle my emotions, and that's caused me to make bad decisions. And, man, I'll tell you, in 1994, when the mortgage market blew up and Orange County California got called away on a bunch of levered interest rate derivatives, that cascaded to the convertible bond market. And I never experienced that. I never experienced something that had nothing to do with me affect my book. And, I had the worst personal career moment during that period of time, because what I would do is I kept doing what I was doing in the face of things that were going to cause me to get too big and take too much loss and having to unwind. And I've had enough of those experiences in my career, and I've had enough of experience with people who have had that experience managing them, being managed by them, to recognize that sizing is the most important thing. That this is a game in which staying in the business the longest when you have edge, staying in the business the longest is the goal. And to do that, you just can't blow up. And so my current strategy, for instance, I will not allow myself to ever, under any circumstance, have more than a 10% drawdown in a day. Just won't. It's because I know that if I were to have a 10% drawdown in a day, I would not be able to handle it. Now, can you do that in all strategies? Yes, I think you can. But what you suffer for doing that is you underperform. I mean, if you can take more risk, you can make more return. And so the question is then, what is your goal? And I would say that most investors right now do not have the patience to let their returns compound. And they expect, and they've been rewarded by expecting that over years and even over months, that taking a whole bunch of risk and generating a whole bunch of return, which could just be lucky, can change your life. And if you approach investing like that, you're going to lose money. You're going to die, or you're going to get lucky and you're going to succeed. Because even a great process that has an astounding win ratio of, odds of success of 60%, if you bet all your money on and you have a 40% outcome, which is very common, 40% is like really common outcome, and you lose all your money, you're dead. And so I think that's the first thing. The second thing is systematic. To the extent that you can take emotion out of your process and follow a system, that can relieve you of that. But it doesn't relieve you completely, because we all have a boss. And that's that boss can say, I don't give a crap about, sorry, give much about your system. I've lost too much money, I'm out. And that could be your significant other, that could be your boss, it could be your investor. And so sometimes things are taken out of your hands. And so even the most systematic trader can still get a margin call. So that is about communication. Those who rely on your return stream need to understand as best possible how your returns can vary, so that they know what to expect and know what they can tolerate. Now, they could be capricious. They could have other pressures on them. Bridgewater's entirely systematic, but if XYZ company, who is a large investor in the Bridgewater fund, gets a margin call because they on another investment, they're going to redeem the Bridgewater investment because their investor needs to redeem it. So, you have to recognize all those things are happening at once. And if you do, and you can communicate what your expectations are as best possible, and live honestly within those expectations, you're doing everything you can to create a system that you can live with through time. And I think the discipline, there are some people that are just disciplined, and I think the discipline typically comes from experience, but I'm not a big believer in experiential learning generally. So it's possible that it's just the way you're wired, that you do everything in a way that is disciplined. Now, that doesn't mean you are disciplined in your diet or your health regime. It just means you're disciplined in this particular aspect of your life. I don't think those necessarily correlate, that one is disciplined in everything they do. So, I think that's how I'd answer it, which is it's a really hard game of self-awareness and awareness of those who are dependent on your return stream, and on realistic application of scenarios to how you could lose money, and proper tail protection and proper sizing and all manner of things like that.
Know thyself. And
I think it has to start there.
Pure brilliance. Andy, this has been absolutely amazing. I've loved this. You are truly special, and we all appreciate you so much. Thank you so much. Please tell our audience how they can follow you. Tell them about Damp Spring and Two Great Beards.
Sure. Well, thankfully, we've got those domain names. So
that's awesome.
Follow me at Damp Spring on Twitter, and dampspring.com on my website, and follow Nick and I. Nick is at NickGiva2, and at Two Gray Beards is our firm Twitter handle, and twograybeards.com. And again, we're looking to, Damp Spring is about meeting you on your particular path of learning and escalating you along that path as quickly as possible. It's high effort. It's big feedback back and forth. And Two Gray Beards is 15 minutes a week, and you can have better conversations with your asset manager who is charging you tens or hundreds of thousands of dollars for their advice, and who you're not optimizing.
Thank you very much. Underserved, much needed in the investing community. Thank you so much, Andy.
Thanks, Rosanna. It was a pleasure.